IAS 2 deals with inventories. It's one of the oldest accounting standards, but still incredibly relevant. And the key rule in IAS 2 is that inventories must be valued at the lower of cost and net realizable value. And what that means is a business can't recognize any profit until they've made the sale. But if they are going to recognize a loss, they need to recognize that immediately by writing the inventory down to its net realizable value, which is really how much they can get for selling it, less any cost to complete the product. And so when you're looking at the cost of inventory, there are a couple of methods that companies can use. They can use first in, first out, or they can use an average cost method. Now in America, they're allowed to use last in, first out. It's not allowed by IAS 2, but the method that you choose can have dramatic impacts on the gross profit. Walmart in America recently stated that by using last in, first out, they reckoned it would have cost them $1 billion in gross profit, compared to if they'd have chosen to use first in, first out, or an average cost method. So there's not as much choice in the cost, but the choice of method is important. Where the significant judgment is in that net realizable value, and that's a figure that auditors will test very closely. They will be looking at what post-year-end sales have been made of those products to really ascertain, are they being sold below cost or not? And that could be if it's a supermarket, looking at food they have to write down or to donate, and it could be fashion businesses looking at any poorly selling lines and any difficulties in different products. A big example of that is Adidas. When they broke ties with Kanye West, they are left with, in 2022, 400 million euros of Yeezys. And they would normally sell those shoes for 1.2 billion euros. But in their books, they're at 400 million. And they didn't know what to do. They'd committed to not selling those products, which would suggest they have a net realizable value of 0. But because they had the decision to make of whether they would destroy those products, or whether they would rebadge those products and remake them under a different brand, or whether they would give them away, they decided that they were probably quite likely to still sell them and either sell them at cost or sell them from a profit and give that profit to charity. So they decided that they could still get at least 400 million euros of value from that. But in the disclosure notes, they did disclose we still may give these away or we still may destroy these, and that will lead to obviously a significant loss of 400 million. So in companies' accounts, it's a really judgmental area, and there will often be big disclosures about that, and it will often be a key audit matter within an audit report.